Man, oh man, do we got some numbers to go over on today's video because we're going to be talking about the CPI that was released this morning. Now, the numbers, I'm just going to be honest with you guys. They came in high. They came in much higher than expected. These numbers were hot. We're going to dive into the numbers a little bit, talk about some individual factors when it comes to the CPI. But then we're going to tie this all into the stock market and how this is looking good for our thesis, and our picks might start printing money soon, sooner than I originally thought, because these CPI numbers are hot. So let's talk inflation, let's talk the stock market, and let's talk stocks that are going to do well in this kind of environment. So let's get into the video. Hola mi gente, and welcome back to the channel. This is John from We Are Investing, a channel that is dedicated in investing and personal finance. I thank you so much for clicking on this video and joining us on this video, because this is a very important topic. It's a topic that people need to understand, people need to realize, and people need to keep an eye out on. 100%. I truly believe that. This might be boring stuff, but if you're invested in the stock market, this is stuff that you need to know. Now, if you want to join us, we got a Patreon with over 500 investors where we talk stocks and cryptos every single day. You can join us in this journey to become better investors by clicking on that Patreon link, which will give you access to that Discord server where you can see what stocks I'm buying, and we also share our due diligence with all of you on the Discord. So click that link if you want to join us. But let's just get into the numbers because they were hot. So all items, the CPI for all items, year-over-year growth was 5.4%. This is a really high number. The 1 month increase was 0.9. Now this is big, and this was much higher than expected. But let me explain why it's a big number. In April, we posted 0.8. In May, we posted 0.6. So we had actually a drop in month-over-month increase. We went from 0.8 in April to 0.6 in May. So we dropped. And now we went back up and we actually broke those April numbers. So the trend here, it was starting to look like it was going down, and now it looks like it's going back up, and it's going back up pretty quick. Now, the biggest items in here that grew year over year, these numbers are sky high. They're really, really high. Gas, 45% year over year. That's really expensive. Pipe gas, natural gas, gas to heat your oven, to heat your house, 15.6%. Now, if these numbers stay high in the winter months, that's going to be painful to warm your house if you need to do it that way. Used cars, 45%. Now, I own a F-150 truck. I own a 2019 F-150 XLT four-wheel drive, and listen to this, right? It's a 2019. It's used. It has miles on it. It's got like 40,000 miles. I could sell it in today and make $10,000 off that vehicle. $10,000 over what I paid for it, and I've been using it. The issue here is I can't just sell it because I need to buy another vehicle, and the other vehicles are super expensive, and the new trucks, there's not many of them, and they are also expensive. So I can't really take advantage of this opportunity of super high prices, but it's just crazy to think that I bought a truck, drove it for a couple years, add mileage to it, and I could sell it in and make money. Like, usually when you buy vehicles, they're not investments. They are not going to return you money. And in this case, with the 45% year-over-year growth in used cars, I'd be making money. Transportation is also up 10.4%. So as you can see here, energy and used cars is a lot of the CPI. But if you subtract those and you subtract food, your year-over-year growth is still high. So all items with everything included, it was 5.4%, but all items less food and energy is 4.5% increase year over year. Now, this is the fastest pace of growth since the summer of 2008. And you know that 2008, 2009 were not good years financially for the United States of America. That's when we had the Great Recession. That's when we had that financial crisis. So these numbers are a little bit concerning. Now, take this with a grain of salt, right? We are year-over-year growth. We are comparing numbers to the pandemic numbers. So that is why they are high. Now, they are higher than expected, and this is not a good sign, but it's expected. I know these numbers are higher than expected, but I think anyone with a brain would know that inflation is going to be hot. We could see it with your own eyes. You see it when you go to the gas pump. You see it at the grocery store. You hear it in the news. I mean, if you're not paying attention, you're not paying attention. But if you are paying attention, you know that inflation is sky high right now. So, well, what did the market do off of this CPI numbers? Because everyone wants to talk about, oh, CPI numbers are coming out. But what did the market do? How did the market react? And typical of this market right now, and this should not fool you, it's a little bit deceiving, but the market overall did not drop that much, but yet it did. That's confusing. What do you mean? It didn't drop that much, but yet it did. What do you mean, Sean? Well, what I mean is that the S&P 500, the NASDAQ, and the Dow, they all dropped like 0.3, 0.5%, which isn't much in one given day. I mean, it's a decent amount. Those indexes aren't supposed to move that much, but in today's market, they move down 1%, and then the next day they'll move up 1.25%, and they'll continue with their record highs and just moving up to the right. So it wasn't really a big drop in the indexes, but you did have a lot of stocks fall. Of all the stocks in the stock market, 5,000 were red today and 1,600 were green. So you had way more losers than you had winners. But how is that possible when the market only dropped a little bit? And that's because of FANG. That's because of mega cap tech. That's because of companies like Facebook, Amazon, Apple, Google, Netflix, Microsoft. All those big cap tech stocks, they moved up. They broke record highs. They continued on up. And when those stocks move up, they have such a big holding on the major indexes. They are such a big holding of the S&P 500 and the NASDAQ that when they move up unless you got so much selling pressure everywhere else, and then you just see slightly red. And that's deceiving of what's actually happening in the market. It's like that picture of the stock market and the economy where the stock market is FANG. The house looks really nice up front, but behind it, the rest of the stock market, they are dropping. And it's providing opportunities, quite frankly. So what we've been talking about on this channel for quite some time now is we've been talking about the 10-year and why I think the 10-year was going to increase. The 10-year got as low as 1.25%, and I came on YouTube and I was telling you guys the 10-year is going to rebound. The 10-year is too low. The 10-year is going to rebound, and certain stocks are going to jump up with it. And I think that's going to happen, and it's starting to happen in my personal opinion. Today, the 10-year rose 3.82%. Now, I don't like it when the 10-year increases or decreases by that much. It's not supposed to be volatile. But it jumped 3.82% today, and it closed out at 1.4%, which is quite higher than 1.25% where it was at last week. Now, part of the reason why the 10-year increase, in my personal opinion, has to do with these CPI numbers. But the biggest reason, and the media is not going to cover this that much, is we had bond auctions today, and the auctions were bad. They were not good. Buyers did not show up to these bond auctions. And the way yields work on treasury bonds and treasury notes is the more buyers you have, the more people you have willing to buy bonds, the lower the yield is going to be. If you don't have buyers showing up, that's going to increase the yield. And that's what we saw in this bond auction. We did not see buyers. So people are not really interested in bonds because maybe they think inflation is going to be hot, or maybe they think the economy is going to grow stronger than expected, and they can get money better, and they can make more money elsewhere, and they're not really interested in a 1.4% growth because of the 10-year index, or whatever the 30-year was. I think it's around 2%. So the bond auction was really weak. Buyers did not show up. And the fear index, the VIX of the stock market, it shot up 6%, and right now it's trading at 17.12, which 6% is a nice increase in the VIX, but it needs to move up much higher to see some kind of selling pressure in the overall market. So let's wrap this all together. The thesis remains the same, guys. I am telling you this time and time again. What stocks do you want to be buying? What stocks am I buying right now? I'm buying financials because if the 10-year increases, financials will do well. And I also like the fact that they are increasing their dividend yields and they are buying back shares. Also, energy, 45% in gas, year-over-year increase. And it's not stopping there, in my personal opinion. If you know what's happening with the crude oil markets, there is a potential we could see $100 a barrel. Right now, it's around $75. So $25 increase per barrel in oil could send oil stocks soaring. So Exxon, Chevron, Oxy, whatever oil stock you want, I think is a good trade right now. It is risky because oil is a risky bet, but if it moves higher, there could be a lot of gains. And also the reopening trade. Inflation is partly a sign of economic strength, economic growth. The more money people have, the more they are willing to pay for something. When you see economic growth, you will also see inflation. You just cannot let inflation get so high that it outpaces economic growth and things become too expensive. But I think we are seeing wage growth, and the outcome that I think is most likely, the Federal Reserve has printed a ton of money. There is no doubt that the Federal Reserve has printed a shit ton of money. And that is very, very scary. But what is the most likely outcome in my personal opinion? Well, we will see wages increase, partly because there has been a labor shortage and companies are paying more to get employees, to get workers. They need to do so to attract workers because they need workers to stay afloat. So wage increases are a thing and they are happening. And wage increases are not transitory. I do not think an employer is going to employ you and then decrease your wage. That is very hard to do. And unless we are in a situation where they can find employees for a cheaper dollar, they will not do so. They are going to pass that price down to the consumer. So with wage growth, you will also see inflation. You will see prices increase on goods because of two factors. People are making more, and also companies need to stay profitable. So if they're paying their employees more, they're going to have to increase prices. So the outcome that I think is most likely is you are going to see wage increase and you're going to see inflation. And with that, I wrap up today's video. It's been real, mi gente. Like I said earlier in this video, please consider hitting that subscribe button, ringing that bell, and smashing that like button. And most importantly, join the community of over 500 investors where we talk strategy every single day. We stay in tune with the market. And a smart investor is a wealthy investor. So I'll catch you guys on the flip side. It's been real. It's been fun. It's been real fun. And this is We Are Investing. And together, we are invincible. Dale!